Good afternoon, everyone. Thank you for joining us. My name is Janet Wright. I am an outreach specialist with the FSA Outreach Office, and I have with me today Rob Holcomb, who's going to walk us through some tax strategies for crop insurance. And so before we get started, I just want to give you some housekeeping items. If you have any questions, please drop them in the Q&A box, and Rob will do his best to answer as many as possible before our session is over. And with that, I'm going to turn it over to Rob.
All right. Well, thank you very much, Janet. Appreciate the opportunity and the invite. It's always a pleasure to do these webinars. So, folks, my name is Rob Holcomb. I'm an extension educator with the University of Minnesota Extension. I'm coming to you today from my office in Marshall, Minnesota, located in the southwestern part of the state. I've been with the University of Minnesota. I guess coming the 1st of October, it'll be 20 years. And I have statewide duties, but I primarily work in the areas of farm business management with an emphasis on tax. I also happen to be the tax director for the University of Minnesota income tax courses. So with that, let's go on ahead and dive in. I time wise, folks, I'm not going to rush through I don't have a terrible amount of slides, but there's a lot of hard-hitting important information that we've got here. The first thing that I want to lead off with is this is a slide that I typically show at our tax schools for producers when we do a farm estate transfer program. I also have a curriculum on business structures that I teach. Be a good consumer of professional services. Uh, Folks, one of the scariest phone calls that I can get is somebody calls up and they say, "Oh, I bought some off the shelf software and I'm trying to do my own tax return." Uh, Folks, please be a good consumer of professional services. Those I don't want to disparage any of those software products that you can buy off the shelf, but they don't ask all of the questions that they should ask. All right. There's very, very seldom have I ever looked at a self-prepared return where it wasn't just laced with errors. So I really think to do your own return, you're doing yourself a disservice. Now for the program today, I'm pulling information from a number of sources. University of Minnesota is affiliated with the Land Grant University Tax Education Foundation. That's a 30-state nonprofit made up of land grant universities. They put together publications that we utilize for our income tax courses. Also, we're pulling stuff from ruraltax.org. That's a group of educators from across the country that I happen to be affiliated with. We're part of the National Extension Income Tax Education Committee, and the website that this group populates is called ruraltax.org. If you go to there's a website that you can either type the ruraltax.org or you can use the QR code. And finally, I am using some material coming from Internal Revenue Service as well. So those are pretty much where my sources are coming from for the program today. Now, agenda-wise, what we want to start off talking about, and the focal point of today's program is the crop insurance reporting. Uh, Largely, folks, the reason that this is coming up is we had some really, really devastating weather events around the country, especially back in June. I had the fortune to be able to go on an overseas trip at the end of June. I was gone for 9 days. Folks, during that 9 days that I was gone at the end of June, here locally in Marshall, we received over 17 inches of rain during that period of time. Planting, was really, really delayed. It had been delayed because we were already wet before that happened. And the result of that is we've got a lot of fields in the immediate area where I'm at where we've got a lot of drowned out spots. We've got a lot of fields that just they're probably going to go to prevent plant because the producer just wasn't able to get into the field. So the and it's not just Southwest Minnesota. You're going to find this in the Dakotas and Iowa and Missouri. There's been flooding all over the country that's been happening this year. So what we want to do is my assumption is, and I think that's going to be true, is we're going to see a lot of crop insurance claims this year. So that's the purpose for the discussion to begin with. Uh, Part of this discussion, we do want to look at those reporting requirements. We also want to differentiate between revenue protection and protection for damage and destruction, because those get treated differently for deferral purposes. And we want to talk about the requirements of the election. And then I also want to take a few minutes at the end of our program and talk about some tax mitigation strategies. If you do receive crop insurance payments this year and you happen not to be able to defer it, what are some other things that you can do to help mitigate that payment, which incidentally is going to be taxable. So in general, when you're talking about crop insurance and disaster payments, all right, assuming this group is made up of farmers. Of course, that's going to be a Schedule F income reportable event. It's going to be you're going to get a you're going to get a 1099 you're going to get a 10 form 1099, which is something that you have to report on your tax return. Typically, crop insurance is going to be reported on Schedule F. And now what happens is, depending on the timing of the payment, uh, there are provisions in the code where sometimes a person might be able to defer those crop insurance payments. Now I'm not going to give you a litany of code sections or anything, but this is something that you might want to note is code section 451F that has a provision for a 1-year deferral. Now, the what that 1-year deferral allows you to do now, of course, there's requirements that you have to meet in order to be eligible for that deferral period. But the whole idea is that under your normal marketing practices, the crop that you're growing in 2024, you may, as a habit, not market that crop until 2025. Right? So all of a sudden you get a crop insurance payment in 2024, it's taxable income in 2024. All of a sudden that turns your cash flow and tax planning upside down, because you're getting income in a period of time that you're not normally used to getting that income. So that's the whole idea of this discussion. Now, if you get a payment late, meaning that, let's say, for instance, that you had damage to your crop in 2024, meet with the crop insurance agent, you got a claim, but the payment doesn't show up until early 2025. All right. Under the constructive receipt rules, that's going to be taxable when you have constructive receipt of it, when you have it and you're able to put it into your bank account. So if you get a late payment in 2025, there's no provisions to accelerate that income into 2024. All right, you pretty much have to take that as income in 2025, count it that way, make your plans accordingly. Now, the election to defer applies to both crop insurance and disaster payments for that year. And disaster payments, we've had a variety of ad hoc disaster payments over the past few years, and those are labeled as such. Disaster payments would be coming from USDA. They'd be reported on a 1099-G. Now, a key thing that we want to share with everyone, and what I want to do is I want to get my little laser pointer here. So there we go. This bottom one is a real key item here, folks. you insurance products. I'm thinking back earlier in my career because as you could tell that some folks on here know me, and the ones that don't, yes, he's chronologically challenged. So early in my career, back in the 1990s, that's when these revenue policies started to come out, because in the old days, crop insurance was just due to damage and destruction, and that was it. Well, starting in the 1990s, we were able to not only insure for damage and destruction, but we could also have a revenue guarantee. So you had kind of a double protection with your crop insurance. Now that's something that you have to elect, but the key point to where I'm going with this is revenue insurance is not deferrable. The only thing that you can defer under 451F is the crop insurance that you receive due to damage and destruction. All right, and that is a key point to this entire discussion. So, revenue protection insurance, very common for folks to have both types of coverage. If you do have that type of coverage, and you have a claim, and it includes, it's very likely that it might include both revenue coverage and it might include damage and disaster, then you have to do a reasonable allocation. And that's actually where we're going next in the program here. All right, here's a program example that I kind of recycled this from some of the Lagudif material to give attribution to those folks. But this is kind of a typical example that you would find in a where you had a loss here. Okay, this is a revenue protection policy that's both protecting for revenue, and it's also protecting for damage and destruction. All right, this producer's approved yields 180 bushels an acre. Now, yes, I'm regionalizing this. There may be some parts of the country where that might not be a reasonable amount. Please bear with me. I'm kind of going down the middle on this thing. This producer elected to go 85% coverage. We've got a lot of producers in this area that are going to that 85% coverage, which is the top level that you can get. Base price, and I actually pulled this from AgStar last week when I finalized my presentation. So I think that 466 is right as far as the base price for corn, and this incidentally is for corn. Now, in this case, the harvest price for this producer was 486, but they only got 75 bushels to the acre when they harvested it. So this is a case of we really took it bad on the yield reduction, but our harvest price was over the base price. All right, in a case like this, you won't get any revenue coverage. I mean, there's no way that you're going to get any revenue payments under these circumstances. The only time you're going to get a revenue payment is if that harvest price falls below the base price. All right, and the next example that I'll show you actually has that. So what we do is we look at the guaranteed amount. We've got the 180 bushels. That's our base. That's our our approved yield times our base price times our 85% coverage. We've got basically a guarantee of 213,894, and this is for 300 acres, incidentally too. So our calculated revenue is the 75 bushels times the harvest price times the 300 acres. So we subtract off 109,350, and what's left over is the insurance payment of 104,544 in this case. All right, so that's how that insurance would get calculated. Now, again, what I want to emphasize here is the the difference between the yield and the actual yield. We got 105 bushel difference. All right, so that's where this insurance payment is coming from. There's no price loss because the harvest price exceeded the base price. All right, so when the 1099 comes, if this is the case, we don't have to allocate anything. All right, it's all due to damage and destruction. If you qualify for deferral, the whole thing is eligible for deferral in this particular case. I did put together a narrative for this, talking about the difference between the yields and the fact that the price structure and everything. So everything is due to damage and destruction. That's part of the PowerPoint in that case. So let's look at number 2 here. All right, which is gonna complicate things just a little bit, not horrible, but we got example number 2 here. I'm going to leave a lot of this stuff the same. We've got approved yield on this particular case is still 180 bushels per acre. We got 85% coverage. Base price is 466, but look what I did to the harvest price. All right, now I'm just spitballing this as an example. All right, harvest price in this example 416. All right, I think you know where this is going. Okay, actual yield is 75 bushels per acre. So we still have we still have a significant yield loss, but we have a harvest price that's below the base price. So that changes our calculations a little bit. Okay, so let's look at this guaranteed amount. We got the 180 bushels times the 466 base price times the 85% coverage. So this guaranteed amount is the 213,894. That didn't change from the previous example. All right, but now we're going to look at our calculated revenue. 75 bushels times 416 harvest price times 300 acres. That gets 93,600. Subtract that off from the guarantee, and we actually get an insurance payment of 122.94. All right, in this case. Now, the difference between this is a case of where the harvest price was less than the base price, or so we have 105 bushel yield loss in this particular case. So what we do is we calculate the amount of damage due to the yield loss, which amounts to the $131,440. All right. Then we look at the revenue the revenue portion of this, which is the 142,290 as we calculate the total revenue based on that harvest price that's in there. So what we end up doing, we got two numbers that we have to look at here. Okay, we got the total from damage and destruction. We've got the total from yield. We end up dividing those two. We take the damage and destruction divided by the the revenue portion. We come up with 92%, 92.09%. So we take the total payment times that 92%, which on the previous slide, that was the 122.94. We multiply that times the 92%. So we're actually able to defer in this case 110,779. All right. Looks like a lot of numbers, but it's really not that hard to do an allocation. Again, what we're doing is we're looking at the damage, and we calculate for damage and destruction, calculate for price loss, divide the two to find out what percent the total is of the total payment, and that tells us how much we're able to defer. Okay, let's talk mechanics here a little bit. And incidentally, let me back up here a moment. I'll come back to my earlier statement. Be a good consumer of professional services. All right. I explain this to producers so that you understand some of the gyrations that go on into these calculations, but this is something you need to rely on your tax professional to help you out with. I mean, if your tax professionals go into a, they have required professional continuing education, and my hope is that they're getting some schools where they're getting this type of CPE that's offered for that. Okay, let's talk a little bit about the mechanics of actually making this election. Now, if you're going to do the deferral, all right, these are the requirements. The payment has to be received in the year of damage. We kind of alluded to that earlier. If you've got if you have, you're in the middle of the 2024 crop year, you have damage, you get a crop insurance payment. If you receive the payment in 2024, that's what this requirement is. If the payment happens to show up in 2025, then deferral is not an option because it's already in the next year. You need to show under normal business practices that you would sell the crop the following year. Now, we've got some different rules that we need to pay attention to in this regard. Now, there's an Eighth Circuit court case. It's the second bullet from the bottom that talks about this, and that's where we get a lot of our authority. Now, for folks that are in the Eighth Circuit, we pretty much have to abide by these rules. Now, the Eighth Circuit Court of Appeals includes Minnesota, the Dakotas, Nebraska, Iowa, Missouri, and Arkansas. All right, it's kind of that that upper middle to mid part of the country. But within the Eighth Circuit Court of Appeals, that's where this court case was. And what the focal point of the court case was is that the court case indicated that we have to look at each individual crop. All right, let's say, for instance, that I've got a producer that's growing corn, soybeans, and wheat. Those three commodities. I need to look at each of those commodities individually. Are they selling over half the corn normally the following year of production? Same question with the soybeans. Are they normally selling over half the beans the following year? Same thing with the wheat. Are they normally selling over half the wheat the year after production? All right. If the answer to that is all yes for all three crops, then we're okay to defer. But we need to meet the 50% for each individual commodity. If one commodity doesn't meet the 50% test, it poisons the well and we're not able to defer at all. This is an all or a none type of option. All right. I don't necessarily agree with this interpretation, but this is what we have to deal with. Now, outside of the Eighth Circuit Court of Appeals, all right, you can reasonably, you can combine all the covered crops and look at this as an aggregated amount of crop. If you combine corn, soybeans, and wheat, if you're selling over half of that combined amount, then deferral is allowable, but that's only going to be outside of the Eighth Circuit Court of Appeals. And once again, I know this is a nationwide webinar here. Let's again, Eighth Circuit Court of Appeals includes Minnesota, the Dakotas, Nebraska, Iowa, Missouri, and Arkansas. All right, so outside of that, you have more flexibility with this election. All right, actually making the deferral election. All right, so the deferral election, when you do the deferral, if you decide to take it in the current year, it's very simple. It just gets reported on the crop insurance line on the Schedule F. If you decide that you're going to defer those items, all right, Schedule F, line 6, which we see right here. This is where line 6, it shows amount received in 2020, and this happens to be some old, this should be 2020. This will be 2024 for this year. Amount received in 2024, do this amount, and then it indicates the taxable amount. If we're electing to defer, we need to check the box, and then we indicate the amount that we're deferring to the next year. All right, and then what normally would happen with my software is that once you defer that amount, then when I load the tax program the following year, it will automatically populate that as taxable income for the next year. All right, so this all gets, the mechanics of this all happens on line 6 on the Schedule F. Plus, there's an election statement that also gets attached to the tax return. And the election statement, and I'm going to really go through this fast because this is something that you be aware that there's an election statement, but it's got to have your name and address. It's got to have the language that you're deferring this under 451F. and Treasury Reg 1.451-6. Okay, you got to identify the specific crops, what was physically destroyed, statement that you normally would market this in the following year, and plus it's got to have your insurance carrier, the name of your insurance carrier, and where the payments came from. So on that, let's see. Okay, Scott got a question coming in here. How does the deferral work on a corn silage loss, or can a livestock producer defer income since they're not selling it as a 50% rule? Well, that's the problem, Scott, is that you're not this is not going to be eligible for deferral because you're not normally selling it. If you did get a payment for it, it's just going to be Schedule F income, since there's no plans to market this for cash down the road. That's not going to be a deferrable expense. Sorry, wish I had but that's probably not the answer you wanted, but that's where that's going with that. Here's what a crop insurance election is going to look like. These things all look very, very similar, but it has what we have on there. It's got, the election under the code section. It's got the taxpayer, the tax ID number, social security number, address, and then it's got listings of the crop losses and the amount that was paid. So this is just a quick and dirty what a crop insurance election is going to do. Now, the good part is that when you go to your tax professional, this is normally a click box, and there's not much to that. So again, be that good professional, be that good consumer professional services. So that's more or less how the crop insurance deferral and everything works. Now, for the rest of the program, we talked a little bit about, when you can defer it, when you can't defer it. I think another real key component to this discussion is looking at now that if you got this extra income, if you weren't planning on this income, what do we need to do to mitigate it? All right, so that's more or less what I've got for the second half of the program here. Now, just a word on records here, and this is the only slide I have on this. It's, records are really critical, folks. When I first came to the University of Minnesota, I was a field staff person for the one of the farm management associations. So I worked with a group of about 100 farmers. I helped them with their records. We did fall tax planning. I did the 1099 work. We did an analysis, and then we did the tax return. And you got to know their business quite well. It didn't take long to separate out the good record keepers from the ones that needed help. All right. Universally across the board, record keeping is the least favorite of anybody's chores. They'd much rather be out on the tractor, working the livestock, scouting crops, doing something outside or something with the farm rather than sitting in front of a computer, putting together accounting records. All right. But it is the most necessary. All right. Without a doubt, we've done a number of studies just looking at some characteristics of highly profitable farms, and paying attention to the books, and there's no magic bullet necessarily to being that high profit farm, but what it boils down to is they're doing a lot of little things well. One of which is knowing where you're at pretty much any given time of the year from an income and expense standpoint. Now, going back a few years, I mean, we still had some folks with the association that were doing hand kept record books, and they were doing a fine job with it because that's what they were trained with. Now we're kind of, that generation is kind of retiring off. Computer software is pretty much the big dog on the block for doing accounting records, and I think it does a marvelous job. There's a variety of programs out there that, if you're still struggling with trying to find a good system, uh, you know, shoot me an email sometime. We can talk about that, and I'd be happy to visit with you about that. I mean, I've got some opinions of some stuff that I like to do. I'm not going to mention it on the webinar, but contact me after the fact, and I'll be happy to talk with you about that. But on the software side of things, uh, computer software handles the math really, really nice. Uh, you're not sitting there with an adding machine adding up a ledger book or anything like that. Main thing is to have a system. All right, you need to have a system in order to keep track of income and expense, and and it needs to be something that you keep up with as the year goes along. All right, I've had clients before that procrastinated, and they'd finally come in on New Year's Eve for the fall tax planning. And folks, you could tell that the report had been printed off at 2:45 them. Now, the likelihood that that didn't have errors in it is about zero. So just have a system, keep up with it. The reconcile, that's very simple. Most of our software that's out there has a tool in it where you can easily reconcile all your transactions back to your bank statements, which very simply demonstrates that you've accounted for every penny that went through your bank account. And you still may have some coding issues, but you've accounted for all the cash. That's so important in the books. If you're not reconciling back to your bank statement every month, you should start that. Uh, every system should have sections for farm income, farm expense, capital purchases, which is going to be your purchases and sale of machinery, purchases and sale of breeding livestock, because the thing that we want to talk about, or remind everybody, is that if you've got breeding livestock, say if you're a cow calf producer and you're selling a raised cow, that doesn't go on Schedule F. That gets sold in a completely different form on the tax return. It gets taxed differently. So you need to have that stuff separated out. And I'm also a fan of keeping track of that family living, the personal income and expense. Yeah, it's more work to punch it all in, but if you don't, if it isn't the rule that we want to tell everybody, if it's not written down, it doesn't exist. All right. It's the only way you're going to know what your family living expenses are. This is a chart I've been using for a long, long time. Now, this is a chart that I use for when I was with the association. We were doing fall tax planning. I'd print this thing off, laminate it, have it sitting on the desk and everything. And when we were tax planning somebody, this is how I could kind of walk them through the tax planning portions of this. Now the chart here is real simple. The blue line, and again, these are 2004 tax rate, 2024 tax rates, married filing joint. All right. The blue line here are your regular tax rates. Okay, we got a 10% bracket, a 12% bracket, then it jumps to 22. And if this thing went off into infinity, you'd end up with there's brackets that go all the way up to 37%. All right, but it's a lot more money than what you see on here. This illustrates what we want to talk about here. Now, in the farming operation, there's also this thing we have to take care of called self-employment tax, right? Yeah, on your W-2, that's the equivalent to that. On a W-2 wage earner is your FICA and Medicare. All right, FICA and Medicare for a self-employed individual get paid as self-employment tax. It's 15.3% that's discounted for, because you get to deduct half the self-employment tax paid. So it actually comes out less than 15.3% when you actually file the Schedule SE, but for illustration purposes, I'm graphing this as 15.3%. All right. The green line is just adding the two up. All right. Now, if you live in a state with a state income tax, this is not taking that into account. All right. All we're doing is we're just looking at regular tax, self-employment tax, and looking at what those rates are. So when we tax plan, say like if you come into the office in middle of November, all right, what I'd expect is to see an accounting report. So we've got all the income to date on paper, all the expenses to date on paper, so we can look at where we're at on the net. I'm going to have the depreciation schedule calculated. I'm already going to know what depreciation is coming in. We'll add those capital purchases that you did during the course of the year to figure out what we're going to have for depreciation expense. And say if a person was coming up with a number, say like up here in the middle of the big green hump, right? That's one of the higher rates that you're going to have. Well, it's the highest rate you're going to have on this chart. Uh, because what you have here is you've got we got probably a 37% tax rate, and which is going to include regular tax and self-employment tax. So if a person is here, if you do prepayments or take some accelerated depreciation on machinery purchase or something, if you go from here to here, we're saving a lot of money. We're saving a lot of money pre-buying down from being in the middle of the green hump. All right. And one of the reasons that we have the middle of the green hump is self-employment tax is 15.3%. It goes out here to, it's like 168,000 in 2024, and then it drops down to only the 2.9% Medicare portion. That goes into infinity. But that's how come you see this drop here when you get to the self-employment tax limit, or the Social Security limit. That's why that drops down. Okay, I ran some numbers here, just looking, and there's not much to talk about here. But what I did is I took my tax software, and I just dropped in farm income that was all subject to self-employment tax at different tax levels. And what I did is I calculated the amount of federal tax, the amount of self-employment tax, and that combined amount. I also calculated for Minnesota, so I've got the total here. If you're not a Minnesota resident, the column that you want to look at is this one here, right? And if you have a state other than Minnesota, you can probably eyeball it. Minnesota tends to be one of the higher tax states around, but we're not the highest, but we're certainly not the lowest. Okay, tax planning strategies, and I'm looking here at the clock here, and we're gonna move along here. The things that we're going to talk about here: prepaying expenses, income averaging, deferring sales, accelerated depreciation, and that crop insurance deferral, which we've already talked about. All right, so prepaid. All right, when you're looking at prepaid expenses, under the rules, as long as you're a cash basis filer, and incidentally, for the crop insurance deferral, I think we might have mentioned this, but let me hit this again on that as well. You have to be cash basis filers in order to be able to defer crop insurance. All right, that might not have been mentioned earlier, but let's kill that now. But on the prepays, you have to be a cash basis filer. You have the ability to prepay up to 50% of your Schedule F expenses. All right, and prepays are normally going to be including, you might be buying your fertilizer for next year. You might be buying your seed for next year. You might be buying chemicals for next year. The list goes on. All right, what you're doing is saying, in most cases, you're buying crop inputs for the next year is what you're doing. Now, the mulligan rules that fall into play under this is, the limit doesn't apply if you haven't gone over that 50% limit in the last 3 years and you're a farm related taxpayer. The farm related taxpayer is you got to be engaged in farming, you got to live on the farm, or the family's got to be engaged in farming. And typically folks, the 50% rule, I try to keep everybody under that 50%. You really got, in most cases, you really got to spend a lot of money in order to get over that 50% rule, but it's 50% of the total expenses, including the depreciation that you have on there. Now, with regards to prepayments, this is the rubber hits the road slide. This is the most important thing. When you do prepayments, you actually got to buy something. It has to be a payment. You can't just go to the co-op and put money on account and call it a prepay. You actually have to have a piece of paper saying, I bought X amount of fertilizer, I bought X amount of chemicals, I bought X amount of seed. All right, for instance. So the valid purpose is fixing price and supply. You can't materially distort income, but if you're prepaying every year, you're not materially materially distorting anything. It's part of your regular business that happens. Okay, another thing that's available to producers is income averaging. Now, your tax professional really ought to be doing this already, but the statistics that I've looked at this nationally is the this is an underused technique, and it surprises me because it's not hard. It's one form to fill out. But what income averaging allows you to do, it isn't actually averaging the income. What it does is it allows you to use the unused brackets from the last 3 years. It does not affect self-employment tax. It also does not affect taxable income. All it's doing is it's blending the rates. All right, now here's an example. Here's a graphic that I use in our tax schools that kind of illustrates what's going on with income averaging. Now, this line here, folks, is our top of the 12% bracket. Now, everybody's going to go, well, that number is going to change every year with inflation. Yes, but for illustrative purposes, this line here is the top of the 12% bracket. Money above here is 22% money. Money below this is 12% money. Well, 12, and actually there's some 10% money way down deep. But here's the point. In 2024, we've got a lot of income. In this example, we've got high income in 2024. In 23, 22, and 20, we weren't at the top of the 12% bracket. Right, so we have available 12% bracket in all 3 of those years. What income averaging allows us to do is it allows us to take some of this excess money here and we can put it evenly into these prior 3 years. Now, the rules say we have to put an equal amount into each year. So, you might elect to maybe put, say if I wanted to put 30,000 back, I'd have to put 10,000 back into 23, 10,000 back into 22, 10,000 back into 21, and we get a blending of the rates that way. All right, that's the whole idea between income. That's the whole idea behind income averaging. It's an easy form to fill out. If it gets filled out on Schedule J, and it's something that your tax professional should be doing for you. Okay, deferral of crop and livestock sales. Now we've got there's two ways that you can defer income crop and livestock sales. And largely one is through a deferred sales contract. Now these all fall under the installment sale rules. Now let's say, for instance, what just explain what these things are. If you do a deferred sales contract, which in the area that I'm in, we're a heavy grain area, got a lot of ethanol plants dotting the horizon all over the country here. It's not uncommon for someone to do a deferred payment contract with the ethanol plant. They haul the grain to the elevator, get it off the farm, so they're not having to deal with storage or possibly pay storage at the elevator. But what they've done is they've delivered the crop. They sign a contract indicating, we're giving up ownership of this, but I want to get paid after the 1st of January. Right? That's what a deferred sales contract is, or a deferred payment contract. perfectly allowable. You can't just pull up to the scale and tell the elevator or the ethanol plant to hold the check. You have to have a signed contract. All right. You can't get the income. The risky part about this is that if you do those deferred sales contracts, you are an unsecured creditor. All right. Meaning if something happens to the ethanol plant or the elevator where they get into financial trouble, and you're holding that contract as an unsecured creditor, you're just about the last person that's going to get paid out of the bankruptcy court. So just be aware that that is a risk when you do these things. Okay. Come back to the question here. Is income averaging available if filing status changes during any of the prior or current years? Spouse was married in prior year. Okay, single. Yes, you can. There's just some gyrations that, to answer the question, yes, income averaging is available if you changed your filing status. There are some gyrations that you have to do in order to get that done, but in most cases, the tax preparer software is going to handle that. So answer is yes. Okay, the other thing tax planning that you probably heard a lot about is Section 179. Now, Section 179 is a form of accelerated depreciation. Usually, you take an asset, say like if you bought a tractor or a combine or a skid steer, some piece of equipment, and depending on whether it's new or used, it gets depreciated over 5 or 7 years. So you recover that cost over either a 5 or 7 year period of time, depending on whether it's new or used. With Section 179, we can just write the whole thing off just like that. All right. Our limits are a little over $1 million, and there's a purchase limit for qualifying property a little over 3 million. All right. So you can expense a lot of stuff in a hurry with Section 179. The thing that I like about 179 is it's very flexible. It's easy for practitioners to do that because you can take 179 on specific assets that you bought over the course of the year. All right. Whereas other methods are not quite as flexible. Right. I do like the 179 from that standpoint. Now the other side of that coin is bonus depreciation. All right. Bonus depreciation has been around for probably, well, for over 20 years in some variation of another. But with bonus, it's also accelerated depreciation. But bonus is like a light switch. When you buy qualifying assets that qualify for bonus, say for instance, if you bought a tractor and a skid steer during the course of the year, all right, those are eligible assets. The tax return is going to assume that you're going to take bonus. All right. In fact, that's the default way the way the tax return treats it. You have to elect out of bonus in order for it not to happen. And you elect out by the class life of property. Different assets have different class life, or in other words, the class life is how long you're supposed to depreciate it over. For instance, like new machinery is 5-year property, used machinery is 7-year property, single purpose ag structures like a hog confinement building is 10, drainage tile is 15, farm buildings are 20. Everything has its year's life that you're allowed to depreciate it over. Now, for bonus in 2024, you get a 60% deduction. All right. So if you bought a $100,000 tractor and you let it take bonus depreciation, it's going to take $60,000 and write it off just like that. And that's the way bonus works. Anything that qualifies, it's going to take that 60% deduction. Both 179, back up here just a minute, 179 and bonus both have related property rules that we have to adhere to, and those are very simple. You can't take bonus or 179 on an asset that you bought from a lineal descendant. So in other words, if if I had a tractor and I was going to sell it to my daughter, she can't take 179 or bonus on it because she bought it from her dad. All right. Same thing holds true for grandparents. It's lineal descendants. So you're going grandchildren, you're going grandparent to parent to kid to grandchild. Now, aunts and uncles don't qualify for that. So you can buy from the uncle or the aunt, and that's not considered a lineal descendant. All right, that's usually a question that does pop up. So let's look at the tax planning stuff. We're kind of in the short rows here a little bit. Promised you about an hour, and that's about what we're going to be coming in here at. So on the tax planning side of things, what I did is I ran some numbers when I was prepping for this. I ran some numbers through my tax software and just calculated some actual numbers for 2024, looking at where everything was going to land. Um, you know, I'm going to start with a Schedule F. This was a married filing joint couple, no kids, had a Schedule F of $200,000. All right, the assumption is here it's 100% farm income, so everything is going to be subject to self-employment tax. Once you get done taking the standard deduction and the QBI deductions and everything, which we didn't get into that, we end up with a taxable income of 126,000. All right. Federal tax in this situation comes to 17,856. Self-employment tax is a little over 26,000, or a $44,000 tax bill. No states calculated in this. This is just purely federal. But in this particular case, we're at 126,000. We're in the 22% bracket. So let's look at the chart. 126,000. We're pretty much right there in the middle of the big green hump. All right. So that's one of the reasons two reasons we got a lot of tax on this thing. It's a lot of money. But the other thing is we're up at about the worst rate that we can possibly get for income goes. All right. So to mitigate this, what I'm going to do is, to mitigate this tax liability, we're going to prepay $20,000 for crop inputs, and we're going to take some accelerated depreciation on some equipment that's going to net us an additional $22,000 worth of expense. All right. So in other words, we're adding $42,000 worth of expense to this particular case. All right. So where we're at here is, we're looking at taxable income in this case of 94,000. Federal tax is 10,831. We got the self-employment tax down to 22. We're down to a tax bill of 33,153, but the marginal tax rate we're in 12. All right. So folks, here's what I want to illustrate. All right. Now I know we still got a lot of money on here, but when I do tax planning, I pay a lot more attention to the rates than I do gross dollars. All right. Now, it's a blended conversation, but in this example, we started here with a $40,000 tax liability. And what we did is we pre-bought, we did prepay, combination of prepay and accelerated depreciation to get this down to 94,000, which is going to get you about right there. What I've done is we eliminated that expensive money by prepaying that. Now, obviously, additional prepays and additional accelerated depreciation is going to move you further down the line here, which is also going to lessen that tax liability. But my point is, moving from here to here, there's a significant savings. You're getting a lot of bang for your buck for the money that you're spending going from here to here, whereas to get tax savings going from here down to here, you got to spend a lot more money to save the same amount of money. Let me say that again. You got to spend a lot more. You have to have a lot more expense to get the same type of tax savings. All right. So that's the reason for looking at the chart. All right. So what we did, we spent an additional $42,000 in this prepayment. And what I did is I cut the tax bill by just about $11,000 by spending 42, which that's a pretty good return on money. That's about 26 cents on the dollar. The other thing you got to realize there too is that as we look at these transactions, one thing that clutters this up is I didn't talk about qualified business income or QBI. You probably heard your tax preparer talk about that. It's a 20% deduction based off your profit off your business income. Now, that factors in here as well. As you decrease the amount of income, that also decreases the QBI, but that muddies up the water a little bit, making the chart numbers work real cleanly the way we'd like to see them work. If QBI weren't around, we'd probably be getting close to a 40 cent per dollar difference on that. But with the QBI, we don't have to spend as much money to get that tax savings in that case. So again, what I going back here again, I normally pay a lot more attention to the rates than what I do the dollar amounts. That's going to vary by your operation. All right, it's good. That's an individual choice that you're going to have to make. But as I mentioned earlier, be a good consumer of professional services. Have that conversation with your tax preparer, and because this is all going to weave back to that crop insurance deferral is what it is. And it's never too early in the year to start looking at how you're going to land on your taxes at the end of the year. I mean, I had people when I was with the association, I had people that called me up in the middle part of the year and wanted to run numbers on where we thought the tax bill was going to be for that year, just because they wanted to know. All right, with that, we got questions. I see we have one thing here. Let's see here. Okay. Okay, this is about a NAP payment. I think I missed. Okay, let me Marcia, can you type your original question in again one more time? I don't think. Yeah, can you type your original question in? I'll be happy to address that. But I'm not sure what your question is. With that, any other questions or anything for the good of the cause? Final note here, I'll leave this up here for a little bit. And in fact, the final the person that just asked the question, if you don't want that made public, here's my contact information. I mean, that's my desk phone, and that's also my email address. Please feel free to reach out to me, and be happy to address any questions that you may have. Just a quick note. Please note, I am going to be teaching out of state most of next week, and I'm probably not going to be available the rest of today. But certainly shoot me an email, and I'll be happy to visit with everybody. With that, think and yes, the answer to the question, got a question here about whether the recording is going to be available, and the answer to that is yes. Janet, do you want me to continue sharing my screen, or should I shut that off?
You can continue sharing just to make sure everyone gets your information. And I just want to thank you for joining us today. Rob is able to be with us and other tax experts like him through a series of cooperative agreements the USDA has with the National Farm Income Tax Extension Committee. And we usually do these sessions once a month, and we've been doing them about 2 years now. So to find this recording will be posted to farmers .gov/taxes in 2 to 3 weeks, and those that we've done in the past are already there. So I would encourage you to follow up there for additional information. Also on ruraltax.org at the bottom right of Rob's slide. And for general questions, you can also send to info@ruraltax.org. And for yes, for additional access to other cooperators. I mean, for other tax professionals. And so with that, it looks like there's a couple of things popped up in the chat. Are those things you're going to grab, or you're going to?
We've got okay, the question on the NAP. I'm not exactly sure what NAP in this case is. If there's a payment that was due to your late mother and it's in probate right now, this is something to kind of check with the legal counsel or the accountant that you're working with on the on the uh, on the estate for probate, but typically it is probably going to be a question for the accountant. I mean, it depend. Part of that's going to depend on the state that you're in. I certainly wouldn't think that they would make you go back to 2012 to claim it. I would certainly think that that you'd be able to clear that up in the current year. But that's probably a question for the folks handling your estate.
Okay, with that, it looks like we're at the end of our time and we're at the end of our questions. So thank everyone for joining. You all have a great day.
All right. Thank you, everybody.